Hello, hello. I hope you're having a fantastic day today. Today we're going to be discussing all things credit score. What is a credit score? Why does it matter? And how to improve yours. So let's go ahead and get started. A credit score is a number between 300 and 850 that shows your credit worthiness. And what that means is it's a number that shows how much financial institutions think that they can trust an individual based on their credit history. And so if you have a credit score under 629, that's considered bad. 630 to 689 is fair. 690 to 719 is good, and 720 to 850 is excellent. And there's 3 credit bureaus, and these are agencies that collect data that financial institutions can use as identifiers for your credit score. And these are Equifax, Experian, and TransUnion. There are 5 data points that they look at: on-time payments, credit used, length of credit history, new accounts, and credit mix. And when I say credit mix, I'm referring to different types of credit. For example, auto loans, student loans, credit cards, and mortgages. As you can see, the 2 most important indicators on your credit score are on-time payments and credit used. And we'll go into credit utilization a little bit more when we discuss tips to improve your credit score. So now I'm going to discuss why it matters, and I'm going to do that showing you a mortgage calculator, because this is really the purchase that's going to have the biggest impact whether you have a high or low credit score. And so for this example, I'm using mortgagecalculator.org. I like this particular calculator just because it includes property tax, property mortgage insurance, homeowners insurance, HOA, and everything that you can expect to pay in your mortgage payments. So I'm keeping all the variables the same. The only thing I'm changing is the interest rate. So based on today's numbers, if you have excellent credit, you can anticipate getting an interest rate of around 6.8%. I'm still in shock that it's so high, but that's for another day, another conversation. And so you can anticipate paying about $2,400 a month with the variables that I've input. Now, the only thing I'm going to change is the interest rate. Now, if you have fair credit, you're going to be paying closer to 8.3% interest. And that would bring the monthly payment from about $2,400 to $2,700 a month. That's a $300 a month difference. And over the span of a 30-year mortgage, that can be over $100,000. And while some people may choose to purchase, cars and other big ticket items in cash, this is one thing that most people aren't able to purchase a home in cash. And so having a high credit score is going to really give you the biggest bang for your buck when it comes to financing a home. So one of my biggest goals in life was to have an excellent credit score. Not just excellent, but 850. And it seems like such a weird thing for somebody to want, especially as an 18, 19-year-old. And so as I was preparing for this video, I sat down and I was like, I wonder why it was so important to me. And so I did this exercise that I teach in some of my classes, really kind of trying to understand my motivation behind why I wanted it. And so I sat down and I was like, okay, why did I want a good credit score? And it's like, okay, I want to pay, less in interest. Okay, well, why did I want to pay less in interest? And after going through that exercise, I realized the reason why having a good credit score was so important to me is because it really came down to access to resources. And when I say resources, for me, it was access to housing. So I was 18 years old and I found out that I was pregnant when I was in high school. And luckily I was on track to graduate early and I had a good amount of money saved up, and I went to go get my first apartment and they were like, well, you don't have any credit history, you can't get an apartment. And I was like, is there any workaround for me to be able to move into this apartment? And they said the only way you can is if you have the full amount for the lease for 12 months up front. Luckily, I'd been working all throughout middle school and high school, and I had enough saved up where I was able to pay for the the rent in full for the entire year. So luckily, I was able to move into that apartment. And, time goes on, I get married, I have more children, and me and my husband go to finance a home. Well, we ended up not buying, but we applied for a mortgage, and they come in and they're like, oh, I'm super impressed. You guys are really young, and not only are you approved, you have our lowest interest rate. And it was an astronomical amount, an amount I would never borrow for a home at the time. And the feeling that I had in that moment really kind of solidified why it was so important for me to have good credit. The difference between being an 18-year-old single mom trying to get an apartment and not being able to, unless I had the full lease saved up, fast forwarding to being able to not only get approved for a home, but at the lowest interest rate and more than we would ever want to use to borrow for a home. That was really why it was so important for me to have a good credit score. Alright, so now we're going to discuss tips on how to improve your credit score. Now, first, you may not have a credit card yet, and you may not necessarily qualify for one. So if you're 18 and you're qualifying or applying for your first credit card, or maybe you're older than 18 but you've never had any sort of credit before, you might have to get what's called a secured credit card. And what that means is you'll go to some sort of bank or financial institution, credit card company, and you're like, here's $100, and then they give you a $100 credit card. And that way you can use that card to show your credit worthiness. And then after a certain period of time, you'll get your money back, and then you can get an actual credit card. So that's the first thing if you're just getting started. Another thing, depending on your situation, is you might be able to be added as an authorized user on someone else's credit card. A few things to keep in mind is, one, you need to make sure they have good credit, and two, it needs to be someone that's going to trust you being on their credit card. So this is something I actually have done with my children, because you can add minors as authorized users to most credit cards. And so that's something you can ask your credit card company if you are wanting to do that with your kids. And basically they can piggyback on your credit history if you have good credit, and it shows that they're more likely to be good with money, and it also starts their credit history a lot sooner. And so that's something we've done with all of our kids. The next thing you can do is to increase the limits on existing credit cards. And this can be beneficial over opening a new credit card, because you're not actually taking that hit to your credit by adding another card, you're just increasing your limit. Next is on-time payments. This is the most important. Thinking back to what we were talking about earlier, it's 35% of your credit is based on-time payments. So whether you're setting up auto pay or whatever it is that you need to do to make sure you're making those payments on time is going to be significant. You want to make payments on your credit cards after the charge is recognized, but before they add interest. And so what that means is you go and you use your credit card to buy gas. You don't want to log in and make a payment to pay off that balance. Well, one, it's going to be pending at that point, but also it hasn't been recognized by your credit card company that the purchase has been made. And so when it comes to building your credit, you actually need to use your credit cards responsibly. So you may need to call your credit card company and ask on what date those charges are recognized and on what date they add interest, because you don't want to pay interest if possible. And so in that window, you want to set up automatic payments. So as much as you can afford, or if you can, the balance paid in full in that window of time. And let's say you can't necessarily pay off all your credit cards every single month. You want to, at the very least, have your credit utilization less than 30%. And what that means is if you have a $100 credit card limit, you want to owe less than $30. And let's say your limit is $1,000, you want to owe less than $300. And so that number is your credit utilization. And so ideally you want it to be below 10%, but definitely below 30%. And as you're making your payments and you're paying down your debt, you want to focus on your high interest rate items first. So let's say you have 2 or 3 different credit cards and they have different interest rates. You pay the minimum on all of your accounts, and if you have extra, you're going to make those extra payments on your credit card with the highest interest. So I could go on and on about this kind of thing, but that was a lot of information, so I'm going to go ahead and end it here. If you have any questions about anything I discussed today, let me know in the comments below. And if you haven't already, please subscribe and like the video. Have a great day. Bye.